In today's video, we're going to study about what is inventory valuation. It is the process of assigning a monetary value to the items in a company's inventory. It affects the cost of goods sold, which is known as COGS. It affects the net income and the value of inventory, which is reported on the balance sheet. There are several methods to calculate the value of inventory. We're going to study each of them today. So, the most of the common methods of inventory valuation are FIFO, LIFO and weighted average. FIFO. Now, FIFO, as the name suggests, it is first in and first out. It assumes that the oldest inventory is sold first. Now, it results in higher net income during the inflation and lower cost of goods sold. The major drawback for the same is that it leads to higher taxes. As the cost of goods is less than the income, it will result in more profit and resulting in higher taxes. Last in first out assumes that the newest inventory is sold first. That means last in and first out. Benefits are that lower taxes during the inflation because it has higher cost of goods sold. The drawback is that it is used to understate the inventory value on the balance sheet, which results in unfair picture of the same. Whereas the weighted average cost means assigning the average cost to each item value in an inventory. So this is used to smooth out the price fluctuations, and it can be less accurate during the periods of high volatility. Here the average cost is calculated by the given formula. Average cost is the total cost of all the units divided by total number of units available. Let us understand with the help of an example. So here is the data given for an inventory, which includes the opening inventory, the purchases and the sales. The opening inventory has 100 units at the rate of 10 each, which results in total cost of 1000, and then purchases and then sales. We need to calculate the cost of goods sold and inventory value, assuming that there is a sale of 250 units. Now let us do the same with the help of first FIFO method. That means first in and first out. Here the cost of goods sold will be taken from the ones which have been shown in the beginning. Like this 100 units will go first, and then the remaining will from this 200. So 100 into 10 plus 150 into 12, because we have sold 250 units. So taken 100 units from the beginning and then remaining from the next lot. So which gives us 1000 plus 1800, which is 2800. Now the closing inventory will include the remaining inventories which are there. That means 50 from here, because 150 is already being sold. That means 50 is remaining, and then 100 to 14, which will give us 600 plus 1400, that is 2000. Similarly, last in first out. Here the cost of goods sold will be from here. Like this 100 will be sold off first because last in, because this was the last lot, and then remaining 150 from the lot above that. That is 1400 plus 1800, that gives us 3200. And similarly the closing inventory will be 50 into 12 plus 100 into 10. So this will give us 600 plus 1000, that is 1600. Weighted average cost, the most simplest one is that we need to sum the total cost. Like we have to get the total cost, which is nothing but the sum total of this 1000 plus 2400 plus 1400, which is 1000 plus 2400 plus 1400, which gives us 4800. Whereas the total units were 100 plus 200 plus 100, that is 400. So average cost is 4800 divided by 400, which is $12. Now cost of goods sold, very easy. 250 units were sold, so 250 into 12, which gives us 3000. And closing inventory, we had total stock of 400. Now from 400 we have already sold 250 units, so remaining is 150. That is 150 into 12, which is 1800. Now in this way we can calculate the value of inventory using different methods as adopted by the company or the organization. Now this basically depends upon the tax strategies, reporting standards, industry norms, and also the inventory turnover rate and price volatility. Thank you.